Hey everyone, welcome back to Corporate Decoder, the place where we break down those dense financial reports to see what is really going on behind the corporate curtain. Today we're diving into some pretty significant changes at Matthews International Corporation. MLTW, a company that's been around for ages, they've been busy, really busy. And their latest proxy statement, which is basically a shareholder's guide to what is happening, lays it all out. Get ready, because this isn't just about numbers, it is about strategy, leadership shifts, and a big shakeup that could redefine the company. Before we jump into the juicy details, if you are someone who likes to know what is happening in the business world beyond the headlines, hit that subscribe button. We break down these filings so you don't have to. And if you want to chat more about these insights or ask questions, join our Discord community. The link is in the description below. Matthews has been actively reshaping its business portfolio, and man have they been active. One of the biggest moves was selling off SGK Brand Solutions. They got $350 million up front and a 40% stake in a new company called Propolis. The company believes Propolis is already doing way better than the $100 million in adjusted earnings before interest, taxes, depreciation, and amortization that the old SGK business was pulling in. This is a pretty smart move to tap into cost savings and growth that Matthews might not have achieved on its own. Then, in December, they dumped their warehouse automation business to another company called Duravant for a cool $230 million. They think this sell price was a really good deal, much better than what the market might have expected. It seems like Matthews is strategically shedding parts of its business to focus on what they believe are their strongest areas. And it wasn't just those two big sales. They also bought the Dodge company and sold off some European packaging and tooling businesses early this year. 2026. It's clear they are streamlining their operations, selling what doesn't fit and buying what does. All part of a big strategic review aimed at making the company more focused and profitable. This whole selling spree is aimed at one main goal: paying down debt. They want to get their debt levels down to what they call their long-term net leverage ratio goal of 2.5 times. That's a standard financial metric, and hitting it means the company is less risky and has more financial wiggle room. And it's not just about selling. In 2025, they managed to cut down their total debt by about $65.6 million. That's serious debt reduction, showing a strong commitment to financial health. But they haven't forgotten about the folks who own a piece of the company, the shareholders. During 2025, they returned over $12 million through buying back their own stock, and about $32 million in dividends. Even better, late last year they hiked their quarterly dividend for the 32nd year in a row. That's a really impressive track record, signaling stability and a commitment to rewarding investors consistently. Leadership is also getting a refresh. The company has been actively bringing in new perspectives to its board of directors. They've added 5 new directors since 2020, which is a significant change for the board. This shows a proactive approach to governance, bringing in diverse experiences and skills to guide the company. Now, a major leadership transition is happening. The current chairperson of the board, Alvaro Garcia Tunon, is retiring after the upcoming meeting in 2026. Has been a key figure, and the company is thanking him for his considerable service and leadership. Taking over as the new chairperson will be J. Michael Norman, who was recently elected to the board. This is a planned, orderly transition, aiming to keep the company moving forward smoothly. One of the main reasons for this shareholder meeting is to elect directors. The company is asking shareholders to vote for 4 director nominees: Thomas Gebhardt, Aleda W. Richards, David Ashok, and Francis S. W. Lodarczyk. The filing provides a table that really highlights their experience. For example, Thomas Gebhardt, who joined in 2025, has a background as a former CEO and has held significant roles at Panasonic, a huge electronics manufacturer where he ran a $13 billion business. Aleda W. Richards, who came on in 2023, is currently the president of Crane Currency, a global leader in currency production, and brings tons of experience in international business and sales. These nominees bring a wealth of real-world business experience, which is exactly what you want guiding a company. Looking at the skills matrix for directors and nominees, it's packed with checkmarks across categories like CEO experience, financial acumen, global operations, and strategic planning. This isn't just a rubber stamp process. They seem very deliberate about ensuring the board has the right mix of skills to oversee a complex global business. The company also highlights its commitment to diversity, showing a mix of genders and ethnic backgrounds on its board and among its nominees. This focus on board composition and refreshment is a strong governance practice. Next up, shareholders are being asked to approve an update to the director fee plan. This plan helps the company give shares to its non-employee directors, which is a common way to align their interests with shareholders. The key is that they want to make sure there are enough shares available to keep offering these incentives. They plan to authorize an additional 250,000 shares. bringing the total available for directors to 550,000 shares. This is a pretty standard move to ensure they can continue rewarding directors for their crucial work. They also want you to ratify the choice of Ernst & Young LLP as their independent auditor for the upcoming year. This is essentially a shareholder's nod of approval on the company's accounting watchdog. The filing shows they paid Ernst & Young about $2 million for audit fees in 2025, plus additional fees for other services. This is a significant amount, but typical for a company of this size. Then to raise the advisory vote on executive pay, often called a say-on-pay vote, shareholders are asked to give their opinion on how the company compensates its top executives. This vote is non-binding, meaning the board doesn't have to follow it, but it is a strong signal of shareholder sentiment. The company mentions that last year's vote was overwhelmingly in favour, with over 91% support for their executive compensation programs. They seem to be doing a good job linking pay to performance. Now, this is a big one for corporate governance. Matthews is proposing to declassify its board of directors. Right now, the board is split into 3 classes, meaning directors are elected for staggered terms, not all at once. Declassifying means all directors will be elected annually. This generally gives shareholders more say annually. They are phasing this change in over 3 years, which is a common and sensible approach to avoid sudden shifts. Closely related, they want to transition to a majority of votes cast standard for directors in uncontested elections. Currently, it is a plurality system, meaning whoever gets the most votes wins, even if it's less than 50%. A majority vote means a director needs more than 50% of the votes to win. This is another move towards greater shareholder power and accountability. And finally, Proposal 8 aims to eliminate some supermajority voting requirements. Right now, certain actions need an 80% vote, which is a very high bar. They want to lower that to a simple majority for most amendments. This makes it easier for shareholders to approve changes, reducing the power of a small minority to block important decisions. These 3 governance proposals together show a strong push towards modernizing their corporate structure and giving more power to shareholders. Let's look at who actually owns the company. As of November 2025, the CEO, Joseph C. Bartolacci, owns about 2% of the shares. That's a decent chunk, showing he has skin in the game. But what's more interesting are the big institutional investors. BlackRock holds 14.1% and the Vanguard Group holds 11.5%. These are massive investment firms, and their ownership means they have a significant influence on the company's direction. Anything they push for, the company usually listens to. Then there are GAMCO entities with 5% and Ameriprise Financial with 5.4%. These big players really shape the company's decisions. Now, for what many of you probably care about most, executive compensation. Looking at the summary compensation table for 2025, the CEO, Joseph C. Bartolacci, had a total compensation of almost $5.7 million. That is made up of a substantial base salary of over $1 million, a huge chunk in stock awards, close to $3.7 million, and then over $760,000 in incentive plan compensation. It's important to see how much of this is tied to performance. The filing details that 81% of the CEO's target compensation is variable or at risk, meaning it depends on the company's performance. This is a responsible approach to executive pay. The company has a lot of outstanding equity awards, with the CEO alone having unvested equity valued at over $7.8 million based on their current stock price and performance metrics. This shows a strong long-term incentive component for the executives, something that can really drive performance if the company does well. The pay versus performance table aims to show how executive pay aligns with the company's financial results. For 2025, the company's total shareholder return was about 126%. That sounds good, but looking at the peer group, their average return was over 171%. So, while Matthews did well, they underperformed their peers in terms of stock performance. This disconnect is interesting. The CEO's compensation actually went up in 2025 to over $7.8 million, even though the stock performance was below peers. This is a point to watch. The non-CEO executives also saw their pay increase significantly to over $1.9 million on average. So, while the company talks a lot about pay for performance, the numbers here show that executive pay is growing even when performance lags behind competitors. This is a classic area of scrutiny for investors. The audit committee, made up of independent directors, has reviewed the company's financial statements and internal controls. They seem confident that the financial reporting is sound. Ernst & Young LLP, their auditor, has also confirmed their independence. So, what is the big picture here? Matthews International is in the middle of a significant transformation. They are selling off non-core assets, paying down debt, and focusing on their stronger businesses like memorialization and energy storage. The governance changes declassifying the board, moving to majority voting, and getting rid of supermajority requirements are all positive steps towards better shareholder rights and accountability. The leadership transition with a new board chair also seems well managed. However, the pay versus performance data raises a flag. While executive pay is heavily weighted towards performance, the actual realized pay has outpaced stock performance relative to peers. This isn't always a bad sign if the company is making strategic decisions that will pay off long term, but it's something shareholders should be mindful of. The company is making big strategic moves to simplify and strengthen itself. The success of these moves, particularly the divestitures and the growth in new areas, will be key to watching in the coming years. Their strategy seems solid, but the execution and how they continue to manage executive compensation against actual market performance will be critical. Alright, that is our deep dive into Matthews International Corporation's latest proxy filing. What do you think about their strategic overhaul and executive pay? Let me know your thoughts in the comments below. If you found this breakdown valuable, the best way to support us is by hitting that like button and subscribing for more corporate insights. And remember, join our Discord community linked in the description to keep the conversation going. Thanks for watching, and we'll see you next time on Corporate Decoder.